Reflecting on the month of July, it was a month of resilience, certainly from the Australian market's perspective. So the Aussie market was up a little over 2%, which was much better than what happened in the US, which was actually negative for the month. More negative on emerging markets, and some of the other European markets were slightly positive for the month in the face of what's been some challenging headlines yet again. So the resilience here was potentially coming through from some of the energy positions in the index. So that was one of the sectors that outperformed on the back of the re-escalation of the tensions in the Middle East, clearly flowing through into higher oil prices and expectations of higher oil prices for the longer term, or medium term at least. Most of the companies on the ASX and the US companies have largely been through their reporting period over the last month. So it's, from an Australian perspective, good to get some insights in terms of how companies are performing and really probably looking at the outlook statements. So the backward look is interesting to know and interesting to see what's been actually happening, but it's more the statements of the companies in terms of what their outlooks are of how things have been trading. So what sort of sales they've been having, what sort of interest they've had for new contracts or for any other services that they may be looking to supply into their customers or into the market. So that'll be watched closely. It does end generally with some higher volatility through this period as well. So that's something really to keep in mind, that keep your hat on and be patient and look through the noise. Really, process and people is a key element that we look at. So we're making sure that the processes are being adhered to, that they're not falling foul of behavioural biases that can kick in when things are a bit more challenging. So we're looking at that, making sure that their processes are robust and being maintained, and that they're positioning their portfolio for the conditions and the outlook for where we're at. Yeah. So while inflation remains sticky, there's still higher interest rate expectations. While that's the case, that may mean there's some challenges in certain parts of the economy. We're starting to see housing prices ease off as well. So you've got a few little headwinds that are kicking in, which you want to make sure that the managers are positioned for what the outlook is today, not what it was yesterday. We've just been through the US reporting season. Those companies that are directly linked to the AI, starting to print real revenue numbers and real profit numbers from forward orders, and now have good back books of orders that are expected. That's actually flowing through into industrial companies as well that are supplying some of the infrastructure build that's going on. You've got some other infrastructure and energy businesses that have performed relatively soundly through the period as well. And so, all those are the second and third order beneficiaries of this AI spend that's going on. And I think this is what markets are looking at in a bit more detail, is looking at the breadth and broadening, being cautious on the capital expenditure that's going on by the hyperscalers, so the Microsofts, the Amazons, and those businesses, because they're spending a lot of the money that they've been earning and returning to investors in profits over time. So that's one to watch, and clearly there's some risks around the challenges in this space as well, with the Chinese advances that they've got with much lower costs and quite similar performance coming through from their AI capabilities. If we think of fixed interest markets in the month, so from a cash rate perspective, still got inflation challenges, and that's starting clearly to be quite broad around the world. We've started to see other economies beyond Australia start to increase interest rates. So we've seen that through Europe a month or so back. US is still holding at a steady level, so I think it's 3.5 to 3.75% is the federal fund rate at the moment, the benchmark level. The 10-year number's starting to increase though, so that's expectations that inflation's a little bit stickier, a little bit harder to control at this point in time, but the Fed's being patient and trying to look through some of the nearer term inflation figures. Australian policymakers were steady as well, and probably likely to remain steady based on the more recent inflation prints.